Moose Miller in for Jordana Green here on WCCO. So here we are with an interest rate increase, a quarter of a point, which didn't surprise anybody today. And our guest can join us now with a few thoughts on maybe where we're going to be heading in the near future, and then also farther down the road here, a year or two from now. We have financial professional Larry Kulvag with us. He is the owner of Haven Financial Group. Good evening and welcome.
Good evening, Moose.
So this quarter of a point didn't really surprise anybody, and it looks like Wall Street actually, I think, liked the news.
Yeah, no surprise. In fact, 93% of investors pretty much expected it. The significance is that they actually increased it because there was some uncertainty as to how much. Well, it was very little, but at the same time, third time in the last 15 months they've done it.
And this is a trend that's obviously going to continue because they're talking about at least, two more interest rate increases this year?
Yeah, interesting enough, 3 times in 15 months. But prior to that, it was near zero since 2008 and the financial crisis, the Great Recession, and certainly it had to be boosted up. This hike in itself, a quarter point, insignificant. However, like you said, 2 more hikes this year as they're predicting, whatever that may be. 3 maybe next year, as a lot of them are saying, the federal officials. Well, that in itself, a series of those hikes, that could affect millions as it relates to investing, borrowing, savings, and so forth.
Well, I remember buying my first house in 1991 and paying 9.5% interest. And I remember at the time people were like, this isn't bad compared to where we've been.
Right. Rates have been significantly low for an extended period of time. So it was just a matter of time.
Sure. Now, do you see or do you think people are going to probably, as I saw, the number of applications for mortgages really jumped up here in the last couple of weeks. What about refis and things like that? People that were kind of on the bubble of, okay, do I refi or not? Maybe they start to get a little bit more serious about entertaining that idea?
Well, I certainly hope they do. Although, the rate hike doesn't guarantee any mortgages as far as that it's going to. They usually go hand in hand. For example, 30-year mortgages, if you watched in 2017, they've been creeping up. As this rate increase goes, those with especially adjustable mortgages, they could see significant difference probably in a relatively short amount of time. So I would encourage those that you're looking at refi, buying, don't procrastinate too long because you might miss out on those low rates.
Yeah, I was going to say, somebody that's sitting on like a 3-year or a 5-year or a 7-year ARM, you really need to be paying attention right now because another tick up, and it can increase a lot more than, 0.5% or 0.25% on an adjustable rate, right?
Significantly. On Haven Financial Group, I do have a mortgage calculator, but we know how those ARMs, we don't want to reflect, but 2008, the real estate bust, we know what happened then as far as it relates to the mortgages. And as it relates to debt, this rate increase, student loans, auto loans, any of those debt things, even if you have perhaps a car lease for that 6 months or less, you may want to look at maybe trading it in or locking in a new contract to take advantage of these rates because who knows where it's going to go.
Yeah, a lot of these auto loans, depending on, who you're working with, some of those can be rather tricky, to put it lightly, as far as, the contract you may be entering in, depending on your credit score and background and all of that stuff.
Correct. Even those could be adjustable. And as you said, tricky. Let's figure it out before the rates increase and you have a surprise.
So do you anticipate June will probably see another quarter of a point going up?
Well, we know that the last 2 Decembers it's happened. June and September are what they're looking at. And I certainly, if, the economy continues to surge, certainly they'll look at that, whether it's a quarter. That's the speculation, depending upon who you ask. Of course, they'll have an opinion, but who knows for sure.
Yeah, now I'm on your website, havenfinancialgroup.com, and that's Haven financialgroup.com, all one word. And you got a pretty slick little refinance calculator there that you can use when it comes to, mortgages and things like that.
Yeah, I encourage you to go to it. You can do lots of things with it, figure out if it makes sense to refi or what that payment could be.
Is there any kind of Mason-Dixon line for people that might have like maybe an automobile lease and they're like, let's say they've got a little less than half a year to go on it, because as they're coming up on, 4 or 5 months from now, they might have been better off figuring out a way out of this one now than, you know what I mean, waiting for the next turn on the interest cycles.
I would look at those options right now because those that have the debt side of things will be affected before the savers. And so I would figure that out now than later to figure out if it makes sense. Of course not, it doesn't always, but rather to be surprised and to tie into the debt side of things, credit cards, another debt, revolving credit, variable rates. I think this could affect people potentially with this rate increase, probably maybe within 60 days. So if you have that high interest credit card, you're carrying it. Of course, everybody tells you, pay it off. But if you can't, if you're getting those zero balance transfers that you've been disposing into the garbage can, you might want to look at those before they go away.
Yeah, because that's not going to be continuing to be mailed out here in, like, let's say, a couple of months from now.
No, those probably could be gone, especially if we get another rate increase.
Oh, for sure. What about, when it comes to savings and people that are in retirement years, does this really affect them much at all?
Well, most of our clients, we serve the 55 and older retirement, those that are close. Of course, the liquid monies, these folks have been looking for some higher rate of returns on their CDs, money market, and so forth. Perhaps they're optimistic, and I don't want to defeat that, but that will probably be one of the slowest things to increase. Banks like a little higher. It gives them a little more margin. And, for example, the last 2 Decembers, we haven't seen really anything change with money markets. In fact, the average has stayed the same. So if you're shopping for those fixed savings type of liquid accounts, rates are still they're going to continue to be low. I'm not so optimistic. Shop around, look what's out there. Don't have too high of expectations. The best we got right now is a 3.1 5-year. You won't get rich, but at least it's something.
Sure. Financial professional Larry Kalvig is with us, owner of Haven Financial Group, as we're talking about today's move by the Fed, which was not unexpected, no big surprise, of raising the interest rate by 1/4 of a point. Are you hearing in circles out there where ideally the Fed would like to, maybe park interest rates a year or two from now? Because, is this something that, as the economy gets better, obviously you increase the interest rates to kind of tap the brakes a little bit so that inflation and things like that don't run out of control?
I'm sure they have where they want to target, but this is a very, very slippery slope. In fact, I'm sure that's why, they've only ticked it up 1/4 rather than perhaps some that said they were going to go up even higher than that. Because when you're looking at volatility, a difference of opinion on the economy and various things as it relates to, of course, the stock markets, usually when rates are going up, you send shock waves down, Wall Street. Not today. Of course, we expected something. But, quite frankly, the interest rates and the stock market, they tend to go in the same direction. However, if they go too fast and there's too much and there's not an acceleration in the economic growth, that can lend itself to a bad formula called recession. And they really got to monitor this and take it slow.
Sure. Well, I remember Paul Volcker back, wasn't he in the 80s and I think even late 70s? Because he really had his work cut out for him back then, trying to get, a handle on inflation. And then we ended up recession, and it was just a wild, incredible roller coaster ride where interest rates were way up there.
Right. Yeah, if the rate increase is too much, too faster than expected, that can lend itself to the turbulence in the market that, of course, we're all afraid of. What, of course, we look at, and I preach pretty much every day, is no knee-jerk reactions, no panicking, balanced attack, simply like you hear all the time, a good financial balanced plan where if there is that market volatility, you're still sleeping, you're not worried, you're in it for the long term as it relates to your approach, and just having a sound plan.
Well, and you're kind of captaining an aircraft carrier. You don't grab the wheel and make a real abrupt turn. It's not in anybody's best interest.
Very accurate. No panic, but have a plan that you can fall back and say, you know what, I did this for a reason, and this was the reason, not just the short term, but here's the end game.
Sure. And for somebody that, maybe is in their 50s and going, I've kind of saved some money here and there, but I don't know what I should be doing now. You're a person that, like you said, kind of specializes in this, really group of individuals out there, right?
That is correct. The balance, as I mentioned, between liquid money, protected growth money, and risk reward, the market monies. If you have a balance there, makes for a good plan and less worry.
Sure. Well, I think a lot of people too today, Larry, are also thinking about, okay, where are we going with healthcare, and what's that going to mean with things like Medicare, Social Security, with this new administration and some of the comments that have come out. That's probably given people, some pause and probably had them thinking, I maybe need to reassess where I am and maybe plan for something 10 years from now down the road, right?
Right. There's a lot of what ifs, a lot of unknowns, some that certainly are kind of scary. I can't tell you how many people that are clients of ours that are still working because they're working for that, health insurance. Where's it going to go? What's it going to cost? Those are all factors as we plug into that plan to figure out, okay, what can we expect so we don't have surprises.
Sure. And you're talking about people that are 55, 60 years old that are hanging on to an employer health plan because, the other option is just not something that's affordable or fits into their budget.
No, it's scary. The numbers are astronomical. And again, we just don't know where it's going to go, whether it's 3, 6, 9 months or 4 years. We just don't know.
Sure.
If you ask 10 different financial advisors or economists, you get 10 different answers. So it makes
I was going to say you get a dozen. I think you get a dozen. I'm pretty sure.
I think you're right.
Well, Larry, it's been a real pleasure. Thank you for staying up with us tonight and sharing some words of wisdom here. And again, it's the Haven Financial Group, and that is Larry Kulvig, our guest here on WCCO, is the owner of the Haven Financial Group. Thanks for joining us.
My pleasure, Moose.